Okay, it's now 10 o'clock. We're now starting to admit people. So if you give 30 seconds, we will get underway with our webinar. Just to let you know, the meeting or the webinar is going to be recorded and will be available at the end when we will send a follow-up email as well. So by the number of people that are joining, it's obviously a very, very topical conversation that we're probably all having. So I thank you all very much for joining and taking the time out of your day to join ourselves as we go through. Just to remind you, there is a Q&A function to the right-hand side of your screens or on the top to then open it up. So please do submit any question, and at the end, we will hopefully get round and answer. Thank you to people in advance that have submitted some questions for us as well. So let's get going. We're here to look and see and how we can help when it comes to what's going on within our mortgage market. My name is Neil Cunningham. I'm the Commercial Director here at Rettie. I'm here to chair and move us through this presentation. You're going to be hearing from our very own Director and Economist, Dr. John Boyle, which gives Rettie a leading position in understanding very quickly what is going on. So John will give you a market overview, and our very own Managing Director within Rettie Financial Services, Bob Duncan, will give you an introduction within our financial market and climate. So let's move forward. Let me introduce Dr. John Boyle, who will now take you through the market overview. John.
Thanks very much, Neil, and good morning, everyone. What I'm just going to do at the start of this webinar is set out the market context and explain what has been happening with a focus really on recent months. Next slide. So this is the long view of the bank rate, and we can see the sharp climb in the recent period up to around about 4% in the bank rate. But in a historical context, this isn't exceptional. You know, the long-term average since the Bank of England set the bank rate back in 1694 is 4.65%. And for a lot of the initial period, it was very stable, you know, around about 5%. After the Napoleonic Wars, it began to move, but usually was in the confines of about 2% to 6%, and was really very much dependent on economic conditions. Then went down to about 2% and stayed there for the 30s and into the Second World War, and only really started climbing from the late 60s due to rises in inflation. So inflation was double digits for really most of the period from the 70s through to the 80s, even into the early 90s. And interest rates were in double digits because interest rates were being used to combat inflation. Interest rates came down then in the UK from about the end of the early 90s, early noughties. And that's because we were getting what was felt to be sustainable economic growth with low inflation. However, we got a bit of a shock with the global financial crisis, but interest rates then went to the floor in order to stimulate or help to stimulate economic recovery. And they've largely stayed there ever since. Now that inflation has again reared its head, interest rates are having to move up to combat it. And this is the latest Bank of England summary of its forecasts, and with the bank rate, it reflects market expectations of where interest rates are likely to go. And this was produced by the bank last week. So the bank thinks that we're going to have a relatively long, but also relatively shallow recession. So we're in recession now, forecast by the start of next year, a drop in GDP of 0.7% before a slow but steady recovery in succeeding years. Inflation is expected, is now anticipated to have peaked and coming down quite rapidly as the energy crisis from last year begins to wash through. So back down to 3% by the start of next year, and then into the low digits by 25 and 26. Unemployment is, though, expected to rise, but these unemployment forecasts are lower than the previous forecasts that the bank had in the previous quarterly. The bank rate is now expected to be around about 4 to 4.25% this year, and then coming down slowly into 25 and 26 as inflationary pressures ease. But what we are getting is a more normalised now economic conditions and more normalised level of interest at around about 3% probably going forward. The days of base rates at 1% and lower are gone, and probably forever. And the swap rate is a major determinant of what's expected to happen with interest rates and with mortgage rates. So a swap rate really is when two parties swap interest payments with each other, and with mortgages, what lenders will pay financial institutions acquire fixed funding for a period of time. So the swap rates really are market expectations of future interest rates. And you can see that the swap rate began to rise significantly, really, from around about the time of the quasi-Kwarteng mini budget, and base rates have followed the swap rate up since that time. But swap rates now seem to have levelled off and have come down. In fact, the latest 10-year swap rate is now under the Bank of England base rate, which again is some evidence that market expectations think that interest rates have now levelled off. But there has been an impact of the rising rates, interest rates on mortgage rates, and therefore on the cost of the average mortgage payment. So the payment on the average house price has increased sharply in late 2022. So what this graph reflects is the mortgage payment on average house based on average loan to value, loan to income, and rates for a 2-year fixed mortgage. And you can see that for Scotland as a whole, which is the blue line, it's increased from around about £800, £900 this time last year to up at around £1,200, although it has now levelled off as 2-year fixed rate mortgages. The average is beginning to drop back. And of course, this just reflects the average 2-year fixed rate mortgage. There are more competitive rates that are available on the market, as Bob will explain later. And the ratio of earnings to average prices has also increased at the end of 2022. So this is the mortgage payment on the average house price, again based on average loan to value, loan to income, and rates for the 2-year fixed mortgage. And in Scotland as a whole, that's gone up from just over 20% this time last year to now touching around about 30 to 35%. Still within historical precedents, and still would be regarded as relatively affordable, and also coming down. But in markets like Edinburgh now, you can see affordability is really getting stretched up to around about 45%. And you're seeing a similar pattern in London and other UK hotspots. And the buying power, or the theoretical buying power based on income and lending data, has also fallen by around about a quarter from its peak early in 2022. So this is the buying power based on 35% estimated gross household income and current lending rates for 2-year fixed rate mortgage. And in Scotland, which is the blue line, there it was over 250,000 at the end of 2021, and now it's down to around 200,000 because of the rising mortgage rates, which have impacted on theoretical buying power. Although again, this now seems to be increasing with 2-year fixed rate mortgages beginning to drop back in recent months. Next slide. And we can look at mortgage lending trends. So this is a new mortgage advantage for house purchases in Scotland, takes it back to 2006. And we're looking at first-time buyers here as well as home movers. First-time buyers, the blue line, and home movers is the purple line. And you can see the collapse that we had in lending at the time of the global financial crisis in 2008 and 9. Lending then has slowly and steadily recovered since this point, really aligned with transaction activity within the housing market. You can see the blip at around the pandemic period when it dropped back, and then it recovered very quickly again. And then the most recent data up to Q4 2022 has again mortgage lending beginning to drop back, and we would expect it to drop back further over the course of this year. But we're not expecting a collapse, you know, the type of collapse that we saw in 2008 and 9. The banks are much better capitalised than they were back then, and mortgages we don't think are going to come under the same level of stress as they did back then either. And there's other challenges in the market, particularly for second home buyers, which includes buy-to-let properties. So additional dwelling supplement, the Scottish Government has just announced that that's now increasing to 6% in Scotland. And that's on top of the land and building transaction tax that you would be paying on a property purchase. So at 125,000, you know, you're not paying LBTT or stamp duty down south, but you are paying 7,500 now in ADS. At 350,000, you would be paying stamp duty of £5,000 in England and just over £8,000 in Scotland. But if you add in the ADS, that's nearly 30,000 in Scotland. And at £750,000, you're paying LBTT of about 48,000. But when you include the additional dwelling supplement, you're up at over 93,000, which is a fair whack of money. So this is going to have an influence really on supply within the PRS, which is already facing significant headwinds through legislation and economic change. So in conclusion, from my context setting slides at the start, interest rates remain low by historical standards, but they have risen sharply due to the energy crisis and rising inflation in the past year. The falling swap rate may suggest that further interest rate rises over the course of 23 may be curtailed. Buying power in the market has been reduced though for those with mortgages due to rising interest rates and mortgage rates. Affordability is still reasonable across the country, but less so in hotspots like Edinburgh. And mortgage lending has dropped back, but it's not collapsed, and we're not expecting it to either this year. Thank you. And back to you, Neil.
Great, John. Thank you very, very much. So let's just move that kind of market kind of run through from where John has been, and let's move it into Bob within financial services, where there'll be a bit of history, and then Bob will then move you through where he sees the market going when it comes to borrowing. So Bob, over to yourself.
Thank you very much, Neil, and good morning to everybody. Great to have you here. What I thought would be good to sort of start is to give you a bit of an overview of, I guess, kind of the key points within the mortgage market. And if we think back, probably the most notable was some of the tax changes brought in for our landlords, which started back on the 6th of April 2014 and were then phased through right through to the 6th of April in 2020. We then obviously all are aware of how COVID came along and impacted the mortgage market and how lenders reacted. During that period of time, the maximum loan to value, or the maximum borrowing you could get, was 85% of a purchase. So all 90 and 95% mortgages were actually removed, and they also refused to lend to the self-employed. So we saw a massive change in lenders' ability to borrow during that tough period in the early days. That being said, we also saw the Bank of England base rate dropping to its record low of 0.1%. And we also saw the lowest mortgage rate available during the COVID periods, where that was currently a product with HSBC, which was 0.39% plus the Bank of England base rate. So being able to borrow at 0.5%. And if we think back to Dr. John Boyle's slides, that is an incredibly low rate of interest compared to where we've been in the past. We also saw during that period that it was the first and only time that I can record buy-to-let mortgages became cheaper to buy or to borrow on compared to residential properties at 75% loan to value. In the sort of post-COVID market, we had 18,000 mortgage products available across the residential market and the buy-to-let market. And what I think we can all say, looking at some of the data, is that property over the years has always been a good investment, whether you're a landlord or whether you're an individual looking to purchase your first property or to move up the property ladder. If we think about what's just happened, and this is probably, I guess, where this kind of webinar has come around, people are trying to understand, what does it look like? Obviously, mortgage rates, if we think about them, have been slowly rising since around November, December last year, and this is due to inflation and the cost of living crisis. However, the mini budget on the 23rd of September accelerated the change in the UK market, especially around mortgage rates. And we saw that in the slides earlier on, where we saw the swap rates rising from their typical lows of 2% to over 7% in a day. On the back of that, we saw lenders remove their products, and over 15,000 mortgage products were removed from sale over a 3-day period. Now, lenders had to remove those products because they needed to reprice. It was effectively going to be costing them more to borrow, and they couldn't allow customers to continue to borrow on those low rates. Now, that sort of started to stabilise, and we now have over 14,000 mortgage products available for residential. And we've got over 2,906 products available in the buy-to-let marketplace. And that is starting to increase slowly, daily and weekly. What we have seen a major impact, and again, if we think back to Dr. John Ball's slides, is the ability to borrow. And that is down to the increased stress tests that have been applied by the lenders. Now, typically, during COVID, that was anywhere between 5 and 5.5% at its peak. And we're now looking based on, specific lenders. It does vary, but on average, you're looking at about 8 to 9% as a stress test, which is obviously impacting people's ability to borrow. Now, we are starting to see mortgage rates drop, and those that haven't seen it, we've just had our first fixed product, now come in under 4%, at 3.95% with Virgin Money, and that launched this morning. So lenders are starting to feel a little bit more relaxed, and we do anticipate that rates will continue to drop, albeit it is going to be very slowly over the next 6 to 12 months while the market corrects itself. What we've also can sort of take away from just even these recent changes is that lenders are now starting to fight for business. There is going to become a sort of price war when it comes to remortgaging or even buying. The markets are starting to stabilize. Lenders are starting to feel more comfortable. So we should see lenders starting to fight for business. So we should, again, hopefully see those rates starting to kind of drop across the board. And what we do have to also remember is that if we compare back to sort of 2008, rates are still relatively low. Yeah. What I thought would be useful to kind of give people a bit of an idea of what we've been able to do for some of our clients is to go through a couple of case studies, and we're trying to sort of make them quite specific, but also real life based on applications that have either completed or are pending to draw down and complete. And if we look at our first one here, and this is all about Shona, who needs the help of her mum and dad. Now, Shona has recently graduated from university. She's got a good starting salary of 25,000, and she's done what most people would do, which is go to her own bank to get an agreement in principle or a decision in principle. Now, what the bank then told her is the maximum that she could borrow was £112,000. Now, Shona didn't have any extra funds. She had a 15% deposit, and that would have left her short of about £33,000. Now, during our initial call, the team explored a couple of options and where mum and dad could maybe look to support Shona. Shona then went away and had a conversation with mum and dad, and everybody agreed to have another conversation on Teams, giving people the opportunity to discuss the sort of options available in a little bit more detail. We did establish that mum and dad had their own property and it was unencumbered, and quite rightly so, didn't want to have another mortgage on their own residence, but we're still really keen to try and support Shona. Our solution for Shona was to look at what's called a joint mortgage sole proprietor application with Barclays Bank. Now, this allowed us to actually use Shona's income and her mum and dad's income to support the mortgage application. But most importantly, the ownership of the property was solely on Shona, meaning that our mum and dad didn't have to pay that dreaded ADS at 6%. And I'm happy to say that that application is fully approved and Shona is now in her property. Got another example here, which is again an existing customer of ours, which is Mark and Debbie. They'd recently sold their own home and had an offer accepted on a brand new home at 550,000, and they had a deposit or equity at 82,500 available, and they needed a mortgage of 468,000. And again, they done what most people do, which is to go to their own bank. And their own bank said the maximum that they would allow them to borrow was 404,000 based on their current and financial situation. Now, we know that the joint income for the couple was at £95,000. And what the team done is they completed a full affordability check. We looked at the criteria across a number of different lenders, and we paid particular attention to make sure we had the pay slips and the bank statements when we were doing this. And by doing that, we were able to go back to Mark and Debbie and tell them that in theory, based on the information and our assessment, they should be able to borrow 492,000. Now, what we then done with the agreement with Mark and Debbie was to go ahead and submit an agreement in principle, and that confirmed a maximum loan, which we had anticipated at 492,000. As you can imagine, the clients were over the moon and slightly shocked that we were able to do that. And the only reason we were able to do that is one of the applicants earned over £70,000. And there are now a number of lenders that will actually allow you to borrow up to 5.5 times your income where you do earn over 70,000. So by doing this, we left their own bank and we positioned the mortgage with a lender called Accord, which is better known on the high street as the Yorkshire Building Society. And again, those clients are in their property and absolutely over the moon that we were able to support them with that transaction. Otherwise, they would have had to pull out and look at another property. Our final sort of case study here is quite a unique one, but it's sort of built around, I guess, a portfolio landlord. And it's around about Stephen, who currently owns 8 properties, which were all mortgage free. And his plan, or he had his great plan, was to purchase another 12 properties, taking them to 20 properties over the next 10 years. Now, again, we brought Stephen in for a conversation, and during that initial meeting, we established a number of key points for Stephen. Now, all of his properties were held in his personal name. All of the income that he received was actually from the rental properties itself. When he was looking to purchase the new properties, he wanted to have what's called a drawdown facility. So rather than looking to keep applying for a mortgage when he found a property, he wanted the ability to just have the money available as if it was in his bank account. He also wanted his wife and his 2 children to be named on the properties over time. And he didn't need any of the income generated from the portfolio now or moving forward. Now, our first action wasn't to look at mortgage advice. It was actually to get Stephen to get some property tax advice around about the current portfolio setup to make sure it was efficient today, but also moving forward, keeping in mind what he was looking to do. We also arranged for his properties to be valued by our sales teams in Edinburgh, and they actually went out and carried out 12 physical valuations. And the reason that was done is we needed to understand the value of the properties. So when we were looking at the mortgage, we knew roughly what we would be able to apply for from a borrowing perspective. We've since then presented this back to Stephen, and we've now provided him with a mortgage solution that meets his goals. The tax advisors are dealing with the first point here, which is to transferring all of his properties from his personal name into a limited company. And that is going to allow him and his wife to be directors, but also his children, when eligible, to become shareholders and then directors over time. We've had his mortgage lending pre-approved on a drawdown function, and our sales team have added our client to our mailing list and are updating them with any properties that come on to the market that meet his requirements. Happy to say that Stephen has now had 2 offers accepted on properties, and the solicitors are now processing the legal work for those 2 transactions. Now, we've also got an app here, and this is available on both the Apple Store and the Android Store. And I would encourage anybody that is a first-time buyer or even a home mover to go and download it. And the reason that I encourage you to do that is that as brokers, our advisors always get asked pretty much the same 3 questions, time and time again, no matter if you're a first-time buyer or home mover. And that is, how much can I borrow? What will it cost me? And can I actually get a mortgage, which is, can I get an agreement in principle? Now, as I say, we would encourage you to go and download it. You do need to create an account, and it takes less than 2 minutes. And the reason that we would ask you to do this is that by doing that, you're able to actually provide information about your situation. So are you a first-time buyer? Are you a home mover? And then what the app will then do is be able to provide you content specifically around what you're looking to do. From there, you can then create your own personal savings plan. You can play with a mortgage payment calculator, and you can even play with an affordability calculator, all live within the app itself. So you don't even need to pick up the phone and speak to somebody. When you're ready, you can then request a call back from one of the team. And because all of your information is in the app, that is then transferred to us. And we're then able to then process an agreement in principle for you. And then obviously answer any other questions that you may have. Within the app, there is an extensive knowledge bank, which is consistently updated, and it covers things from savings accounts, budgeting, types of mortgages, types of insurance available, even down to government schemes that are available for first-time buyers. And encourage anybody that wants to know more or wants to maybe start that mortgage journey to download the app and click on the appropriate link, whether it be through the Apple Store or Apple Android. And the key thing is just to remember that you input the code Rettie when prompted. That way you know that it will be somebody from Rettie Financial Services that will be getting in touch with you. I guess the big question for everybody is, what does 2023 look like when it comes to mortgages? What I think we can say in line with, looking at some of Dr. John's slides, is that we can see mortgage rates are going to continue to fall, albeit that is going to be very, very slow, and that will continue over the next 6 to 12 months. I'd actually say to people to ignore mortgage headlines that hit the press. I think probably, the most notable most recently was that the Bank of England base rate had gone up. However, what the press failed to tell people was that fixed rates were continuing to drop and have been dropping for the last few months. Banks, I would say, are still very cautious just now. However, they are in a far better position when we look back to 2008 and the impact there. As fixed rates do continue to drop, we can expect that those stress tests will slowly start to drop as well, allowing people to borrow a little bit more. And that's all going to just take a bit of time, and we probably don't think we'll see massive changes really up until the end of this year. Again, if we then think about, those that are on sort of higher salaries, again, this is now becoming the norm. Those that are earning over £70,000 a year can now look to borrow up to 5.5 times their income. So a bit of a change for the top end of the marketplace. Again, I think we're going to see a real rate war with the lenders, and that's going to be pushed and accelerated this year with over 1.3 million mortgages coming up for renewal over the next 12 months. And out of recent data, we've established that actually the vast majority of those mortgages are on 2% or lower. So that means that, customers are going to need advice, and they're going to need to speak to somebody. And the reason I'm saying that is, we've done a quick search this morning before coming on the webinar, and the difference on 2 products at 95% is at £275 per month, or over £6,600 over the first 2 years of that product. So it's really key to sit down and talk with an advisor to understand what your options are, but also to make sure that you know what the products are available in the marketplace and how they work for you. If I was to summarize the mortgage market and put it into a conclusion, I would say that the market in 2022 had nothing, or was quite a bit of a roller coaster, but had nothing to do with the 9 interest rate changes, and had probably a lot more to do with that September mini budget. I do think first-time buyers will anticipate to struggle in securing the level of funding when compared to times during COVID, and that is down to those higher stress tests. As we see the mortgage markets relaxing and fixed rates starting to lower and stabilise, we would anticipate that those stress tests will come down. What I would say is if you've got a good deposit, you found a property that's going to give you a good rental yield, or you plan to be there for a period of time, and you have a mortgage that is affordable, and you've had the advice to confirm that to help you make that decision, then we would tell you to get on with it. There is no reason you should hold off. And affordability is the key there. It's making sure that it's affordable for you, and that is where the advice process will really help you. Rates will continue to drop over the next 6 to 12 months as they do continue to adapt from the very high changes or the very quick changes that we had in September. And we do anticipate that the Bank of England will start to stabilise, and we do think that that will come in and around about 3%. And we can then say that mortgage rates on the back of that are going to be somewhere between 3 and 4%. And this is going to be the new normal. We're not going to see, mortgage rates of under 1% or 2%. I think those are in the past. And we are now going to be looking at rates of anywhere between 3 and 4% once things stabilise. But that stabilisation is going to take time, and it is not going to be something that's going to happen tomorrow. Now, before I pass you back over to Neil, what I thought would be good is for you just to see a review from one of our clients, and it's about the service that the team have provided. And what I would say, is if you do want to have a free consultation, don't take my word for it that, I think the team is brilliant, but look at some of the reviews that you will find on Google and across our both Edinburgh and Glasgow sites. Going to pass that back over to you now, Neil.
Great, Bob. Thank you very, very much. I think within using Rettie Financial Services, it's the personal contact that you get rather than the waiting in the queue within the high street. One of the very popular common questions that was coming out on the submitted was more about what type of mortgage would we recommend in the current climate. I would say, is what Bob is saying, it's all about advice. So the QR code that you see on the screen, if you scan that now, that will take you in to be able to book an appointment. Because when it comes to looking at what mortgage is right for you, it's about your circumstances. So it will be all about your loan to value, what you are doing within your day job. So we can't just say now, what would that be? So within the current climate, if that is a question that you have on your lips, then I think it's all about getting yourself an appointment. Scanning that QR code would be great. Shona has reminded you, if you want to submit any questions, we've either done a very, very good job in giving you an update today. There's no questions that are currently submitted other than the ones that have been done in advance of this webinar. But if you do have anything as we move into the Q&A, please do put it into the chat. If we don't get to the end of them, we will be following up as well. So let's just ask a couple of questions. Let's get the spotlight back on to John and back on to Bob, and then just see exactly what we can do. So, John, there was a question that was submitted about repossessions. Do we see similar repossessions, affordability issues coming back to the market as we saw in 2008?
Repossession activity peaked in the UK in 91, so there were over 75,000 repossessions that year. And in 2009, after the global financial crisis, we got back up to around about 50,000. That was double what it was in 2007 due to the distressed sales. But banks then were more reluctant to repossess than they were in the early 90s. They weren't insured to the same extent that they were in the early 90s because you had mortgage indemnity guarantee. And also in the early 90s, the market was much less mature. So that number has fallen back in recent years. So typically, it's under 10,000 a year on repossessions. We'd expect that to rise. So I wouldn't be surprised if that rose to 10 to 20,000 over 23. But I think lenders have been more cautious in the run up to this crisis than they were in the run up to 2008 and 9. But I think you're still going to get some pain, especially with rising unemployment. I think the important thing to note, it takes a lender, up to about 2 years to repossess a property, and it's not an easy process, and you have to go through various stages. And the lenders will look at a whole range of options in order to keep the lender in their property. So it's very much a kind of a last resort. And even in 2009, when we did get that spike in repossessions, it only accounted for about 0.4% of total lending. So it's painful when it does happen to people, but it is relatively rare.
Great, Bob, thank you very much. And a question that's come through on the chat, so thank you very much. Bob, over to you. It's about, is the brokers or are the mortgage team, your team, are they seeing an upside in applicants that are seeking to fix their term of their mortgage for longer? So for instance, beyond 5 years, are you seeing an increase in the weighting of the applicants and what they're asking about fixing their mortgage rates?
It's very dependent on the client, if I'm going to be honest, and it's down to their personal situation and where they are in that mortgage journey. People that tend to fix for long term, and we do have them, looking at 10-year fixed, tend to have a really good loan to value. So where they own, maybe 70 or 60% of a mortgage outstanding, they will tend to fix for that longer period of time. What we tend to find is those, certainly, the younger cohort, will probably be looking at anywhere between a 2 and a 5, because they still want that flexibility. Where am I just now? Do I want to move in the next couple of years, or am I having a family and I want a bit of short to medium term stability? So I wouldn't say we've seen a massive increase in 10-year fixed, but they are considered, and it tends to be those that have got good equity in the property that just want to tie it down and not need to worry about it for the foreseeable future.
Great, Bob, thank you very much. And I think Bob kind of answered the question that I was going to try and answer. Well, just let you know, there is someone that is thinking about entering the market, buying their first home. Should they buy now, or should they wait? There's always questions when we're in a slight adjustment. I always say it's all down to affordability. So as Bob has indicated, if you've got the deposit, you can find somewhere that you wish to live. You can then go and mortgage it, and you can afford it. If interest rates are going to be, or the base rate's going to be the norm at 3%, and as fixed rates are starting to go below base, as we've got, then probably the time is right to continue that journey and go on and take that step onto the property market. So it will all come down to affordability. So if you need any further advice for the person that submitted that question, scan the QR code, get an appointment with one of Bob's broker. But forever, for anyone, supply and demand is always going to continue to drive this market. So you've got to probably go out and see, is there a property out there that you could see yourself living in? That would be my starting point, and then moving it into the affordability. So hopefully that answers that question. John, I think this might be a little bit too early, but you might be able to put this within the kind of the overall forecast that you have within the adjustments and values, and certainly in Edinburgh property prices. But we had a question submitted saying, have we started to see a drop in values after the rise in interest rates when it comes to Edinburgh property? Just need to come off mute, John.
Yeah, I've only had 2 years of practicing that. Yeah, I think one of the pieces of good news that we've had at the start of the year is that the value of property being listed in the market in Edinburgh and indeed in Glasgow is broadly on a par of where it was in 2022. So it's not the case that people are kind of withdrawing from the market because they think the waters are going to get much choppier this year. It will probably take them longer to sell than it did in 22, but there are still people looking to move property, having to move property, and although there will be a drop back in transaction activity expected this year, we don't think it's going to be anything like a collapse. In terms of prices, I mean, not all of the market is, of course, mortgage dependent. It's going to be that part of the market that's mortgage dependent that's going to come under the greatest pressure in terms of pricing, particularly for those with mortgages with high loan to values, they just simply won't be able to borrow or spend as much as before. So our expectations are that, for the country as a whole, and I would expect Edinburgh to be broadly aligned with this, is that there'll be a 5% drop in average prices in 23. And that will probably, if recession continues, shallow recession continues into 24, there will probably also be a marginal drop back in 24 as well, before recovery, which would be aligned with the economic recovery that the Bank of England is expecting. So we're not as pessimistic as some commentators, are seeing forecasts there of 30% drop in prices this year. I mean, that is really, I'm sounding a wee bit like Michael Fish, perhaps, doing the weather forecast before the hurricane hit, but that is definitely not going to happen. And I don't want to be here next year saying I got it wrong. I really can't see that happening. There still is the demand supply imbalance in the market. We haven't had the price boom in the run up to, or a lending boom in the run up to this crisis as we had in 2008 and 9. And even in 2008 and 9, which was a really serious financial crisis with long-lasting implications and effectively a 5-year recession, nominal house prices only dropped back 11% in Scotland. So I think that kind of hopefully sets a bit of context behind it.
No, great. I agree with you. And also we've got to remember property is a long-term investment, not short-term. And some of the real-time advice that what we can see at Rettie within our network across Edinburgh and Glasgow, good quality property is still getting good quality price with multiple bids. So it's the confidence that you have at any point you choose to enter it. Bob, a question back to you, and I think obviously quite common. So within the changes in the marketplace, obviously we have individuals that come into the UK, they're on a skilled workers visa, so they've got access to obviously work within the UK. What has changed, or what is available for an individual if they're looking to invest, purchase a mortgage? What is the advice that you could give these individuals?
Really good question, and one that actually does come up quite a lot, and one that the team deal with on a fairly regular basis. So as an individual coming in on a visa, it is very difficult to get a mortgage on your own, and I would certainly encourage anyone to get advice. There are a number of lenders out there that will consider a mortgage application, even if you've just been in the country a day or a week or a year, but you'll be looking at least a minimum deposit of 10%. To be able to get access to those higher loan to value bands, you will need to be in the country for at least 3 years. That being said, there is a slight caveat to that. If you do come into the country and you have a salary of £100,000 or more, again, we've got a couple of lenders that would consider a 95% mortgage, but your choices are very reduced. And I would encourage anybody looking to buy that has come into the country on a visa, a working visa, certainly to book an appointment with the team, and then they can run through the options with you.
Great. And I'm going to pop it back because this is the focus that is used. So you're on the spotlight again, but I do remember at times. So Bob, can we still, if we needed to, can we get a mortgage with no deposit?
A good question. There is actually one option available. And that might shock some people, but it does require support from mum and dad. Effectively, there is a product in the marketplace from Barclays, and if I remember rightly, it's called Springboard. And what mum and dad do, in essence, is they place 5% or a 10% deposit equivalent into a savings account that is held by Barclays themselves. Mum and dad receive a return on that. But over the term of the product, whether it's 2, 5 or 10 years, they're actually paying off their mortgage. It's 100% mortgage and they're paying it down. And the plan is at the end of that 2, 5 or 10 years, they're able to actually take the mortgage on themselves. And they've built up that equity, and then mum and dad obviously get their money back. There are quite a few terms and conditions to that product. It's not quite as simple as I've made it sound, but if that is something that anybody would like to explore or discuss, again, click on that QR code and get yourself an appointment or a free consultation with one of the team.
Great, Bob, you're fine. So thank you all very much. Bob, you'll be pleased to hear that we've got a very positive thumbs up for someone that has downloaded the home buying app, saying very, very helpful. Thank you very much. I think from all of you that the comments that have coming through it's about advice. So if you're one of those people that is in the 1.3 million that are going to be remortgaging this year, that have had an interest rate protected, then I think it is about advice. Rather than going back directly to the lender that you have currently, is possibly looking at a broker that could give you the spread of the total market to make sure that the product that is available for you works, as you know that your interest rate will rise. So I hope that you have found the information that we've given you today relevant. It will be sent out in a follow-up email. The QR code remains on the screen just now to book your appointment, but we will send you a link in an email to book appointment through clicking into a link. We've just completed our mortgage briefing document, so that will be sent out as well. And then we'll answer all of the questions that we've not managed to answer on this webinar today. So on behalf of Dr. John Boyle and Bob Duncan, thank you very much for your time and the information that you've given us. To our marketing team that has pulled together and navigated smoothly the presentation that you've had, and I hope that you had enjoyed it. It's been very relevant, and you will hear from us again whenever we feel it is right to give you the updates in the continuation and the changes that we are upon when it comes to our markets and relating to property, whether that's rental or whether that's purchase. So thank you from me, and we'll look forward to seeing you very, very soon.